Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: can I max out my 401k and solo 401k? You are in the right place, because in today's webinar, we are breaking down exactly how this works, what the IRS allows, and how to legally double up on your retirement savings if you do it right. Here's the thing: the rules for traditional 401ks and solo 401ks are linked, but not identical. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Chat them over now so that we can be sure to get them all. Let's get started. So here's the thing: the rules for traditional solo 401ks are linked, as I mentioned already, but they're not identical. So you've got three types of limits that come into play. And we're going to cover these. You've got the employee deferral limit, which is shared across all plans. You got the employer, also known as the profit sharing limit, which is unique to each business. And then you've got the voluntary after-tax contributions as part of the Backdoor Roth strategy. So let's cover all these here. So again, you first need to make sure you're eligible to open a solo 401k plan if you don't have one already. So let's talk about the eligibility requirements before we go on here. So the key requirement is you must be self-employed with no non-owner W-2 employees who work full-time in your business. In other words, if you employ any non-owner common law W-2 employees who work 1,000 hours or more in your business, then you would not be able to open a solo 401k plan. And you need to apply that test across all of your self-employed businesses. In short, you need to make sure that none of your self-employed businesses employ any non-owner full-time W-2 employees. There's a spousal exception where your spouse can work in your business. He or she can be a W-2 employee, regardless of how many hours he or she works. He or she does not have to participate in the plan, but he or she can. So this means you can have part-time employees as well. So let's say you're looking to open a solo 401k plan for the first time, and you employ a part-time employee who's W-2 and works less than 1,000 hours. You would qualify to open a solo 401k plan because that individual does not work 1,000 hours or more in your business at the time that you've opened the solo 401k plan. Now, going forward, you should be aware of the part-time self-employment rule as well, which means that, let's say after you open the solo 401k, you hire a part-time employee who works between 500 and 999 hours for 2 consecutive years. If that happens, then that's going to kick you out of qualifying for a solo 401k, and that plan is going to have to be converted to a full-time employer plan, or you can transfer the funds to an IRA. And we've covered that part-time employee rule in past webinars. You can visit our video library on our YouTube channel to access past webinars where we cover all kinds of topics. Now, you can also exclude someone who's under age 21, regardless of how many hours they work. So if you have someone that works 1,000 hours or more, who's under age 21 as a W-2 employee, you can still open a solo 401k plan because the regulations allow you to exclude those who are under age 21 from participating in a 401k plan. You can also exclude contractors. Let's say your business employs contractors, independent contractors. You can exclude contractors. Therefore, you could continue with the solo 401k or open a solo 401k. So those are the eligibility requirements to be aware of. Now, let's talk about how your W-2 job's 401k affects what you can contribute to your solo 401k. So many individuals, especially this day and age, work multiple jobs. They may work for a full-time employer, and then they also have a self-employed business on the side. So they're moonlighting. So can you max out both your daytime employer 401k and then your self-employed solo 401k plan? So the answer to that question depends. So you need to understand the employee and the employer bucket for the contribution sources. You got employee and employer contribution sources. We'll talk about the voluntary after-tax contribution source a little bit later because that one there has its own set of rules as well. But for now, let's talk about employee contributions as well as employer contributions. Now, employee contributions, also known as the employee deferral limit, and if we're talking about tax year 2025, the maximum is $23,500 for someone who's under age 50. Now, that $23,500 employee contribution, that's aggregated between your daytime employer 401k and your solo 401k plan. In other words, you cannot contribute $23,500 to each plan. You can aggregate it where you can contribute all to one plan or some to one plan and some to the other, but you cannot go over that $23,500 limit between your daytime employer 401k and your self-employed business solo 401k. Now, if you're age 50 or older, you do qualify for a catch-up contribution of $7,500. The catch-up contribution is actually part of the employee contribution category. So you could contribute $7,500 if you're age 50 or older, in addition to the $23,500. Likewise, you have to aggregate that $7,500 catch-up with your contributions that you make to your daytime employer 401k. So let's do some math here. 23,500 plus 7,500 catch-up, that's a total of what, $31,000? So you could contribute that entire $31,000 in employee contributions to your daytime employer 401k, or you can contribute them all to your solo 401k or some to each, but you cannot contribute $31,000 in employee contributions to each plan. You have to aggregate those between the two plans. Same thing with the super catch-up contribution, which is a new type of contribution effective for tax year 2025. It only applies to the age group of that fall under the age group of 60, 61, 62, or 63. And that catch-up contribution amount increases from $7,500 to $11,250. So instead of contributing $7,500 in catch-up contributions, you can contribute $11,250 in catch-up contributions. And again, though the catch-up contributions, including the super catch-up contributions, are part of the employee deferral limit. So they have to be aggregated between your daytime employer 401k and your self-employed solo 401k. Now, let's talk about the employer profit sharing contributions. So the good news is that those are separate, meaning that you can maximize your employer contributions to your daytime employer 401k and also maximize employer profit sharing contributions to your self-employed solo 401k plan. So unlike the employee contributions where those are aggregated between the two plans, that same rule does not apply to employer profit sharing contributions. So you could maximize your daytime employer profit sharing contribution, and then if you have enough net self-employment income from your self-employed business, if you're a sole proprietorship, you can contribute 20% of your net self-employment income after you subtract 1/2 of self-employment income tax. Or if your self-employed business is taxed as an S corporation, you can contribute 25% of your gross W-2 wages from your S corporation as an employer contribution. So when we're talking about making contributions to both a daytime employer 401k and then a solo 401k plan, you need to make sure you understand the employee contribution rules versus the employer contribution rules. Okay, let's take a look at some questions here before we continue with our presentation here, which is, can I max out my 401k and solo 401k? Now, if this information is helping you feel more confident about your future, please take 1 second to like and subscribe. It tells the platform this content is valuable, which helps other solopreneurs like you find it. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Also, if you're a financial professional, whether an attorney, CPA, insurance agent, real estate agent, any type of professional for that matter, you can also join our community. Actually, anyone can join our community. You're free to join. But if you're a professional, you can post guest blog posts on our community and link it back to your business website so that 30,000 plus members of our community can review your services, and they may even reach out if you provide a service that'll be helpful for those individuals, whether it's estate planning, retirement planning, financial advice, tax advice. Many of our clients invest in real estate. So if you're a real estate agent or a broker, they may reach out to you as well. So again, please like and subscribe to today's daily webinar. You can also visit our artificial intelligence page as well. Okay, let's look at some questions here. And we'll continue here with our presentation. We've got a question here we've got a question that reads, confirming if I filed an extension and taxes are due October 15, I have until then to contribute to solo 401k, correct? That's exactly right. If you already have a solo 401k plan, and let's say that it was established by December 31st of 2024, then you're going to be able to make all contribution types to the solo 401k plan by October 15 if your self-employed business is taxed as a sole proprietorship. That means you can make both employee and employer contributions as well as voluntary after-tax solo 401k contributions by October 15 of tax year 2025 for tax year 2024 based on your earned income from self-employment activity in 2024. Now, if you did not establish that solo 401k plan until after April 15 of 2025, so anytime between April 16, 2025 through October 15 of 2025, you can still make contributions for tax year 2024. However, you can only make employer profit sharing contributions as well as voluntary after-tax solo 401k contributions. And we've covered that topic in the past. So Secure Act 2.0 as well as Secure Act 1.0 for that matter kind of muddied up the waters regarding contributions for a self-employed business tax as a sole proprietorship with regards to each contribution source type? Good question. Okay, let's see if we have anything else here. So we've got a question here from Erwa. If the spouse is also a W-2, do they have to be partial owner to be eligible for the 25 employer profit sharing contribution? Do they have to, if, it's also, do they have to be partial? No, they don't. Great question. So a solo 401k plan can be utilized by both spouses as long as they're both working in the same business. That doesn't mean that they both have to own the business. So therefore, spouse one may own the business, while spouse two is not an owner, but he or she does work for the business, and therefore they can both participate in the plan and make contributions to the plan based on their respective earned income from self-employment activity in their business. Okay, good question. Please go ahead and type over your questions regarding today's daily webinar, and we'll continue to answer those questions as they come in. In the meantime, give me a moment here to get my slides in order. One moment here. Let me get to my. Okay, so again, please like today's video as it helps get the word out to other solopreneurs like yourself. Okay, we've got a question here from Mike Frank. I opened a solo 401k plan with your firm in February of 2025, transfer from Incensus. How do I confirm that my plan is set up and established? I have not received any correspondence from your staff. I complete the setup and submit a transfer form to Incensus. Go ahead and submit a support ticket and we'll help you determine whether or not your account has been funded yet. Also, you can send us an email to business@mysolo401k.net and we'll take a look at that. Keep in mind, we don't have access to our clients' funds, but we can certainly help you determine or not whether or not your account has been funded or not. Okay, let me send over that support ticket page here. Give me a moment here while I send that link over. So go ahead and submit a support ticket and we'll help you identify that. All right, so as far as today's daily webinar, let's continue here. So again, we're talking about, can I max out my 401k and solo 401k? So we talked about understanding the employee and employer contributions. We talked about aggregating contributions. Let's look at this key rule number one. We've got the $23,500 limit applies across all 401k plans combined. We talked about that. So that's the employee contribution. So another way to refer to employee contributions is as employee deferral limits. So again, if you max out your employee contribution to your daytime employer 401k, you won't be able to also make employee contributions to your solo 401k plan because those are aggregated across both plans, the daytime employer 401k and then the self-employed solo 401k. Key rule number two, employer contributions are separate. So we talked about how you can make an employer profit sharing contribution to your daytime employer 401k, and then you can also maximize the employer profit sharing contribution to your solo 401k. So you're essentially doubling up on employer contributions. Okay, let's see here. Let's talk about a real life example. Let's say Jack is working for a daytime employer Let's say he works for, let's say he's working for Oracle. Let's say he's a full-time W-2 employee for Oracle, and he participates in Oracle's 401k plan. Let's say that he is also self-employed on the side as an IT consultant. He's got his own IT consulting business on the side. So he can open a solo 401k plan for his IT consulting self-employed business. Let's say his IT consulting self-employed business is taxed as an S corporation. So let's say that he makes $100,000 of W-2 wages from his employment at Oracle Corporation. So he could contribute $23,500 to his Oracle 401k plan based on his 100,000 of W-2 wages from Oracle. And then Oracle can make an employer contribution, also known as a profit sharing contribution of $20,000 to his Oracle 401k. So that's going to be a total of what? $53,500. So he will have contributed, $43,500. So he will have contributed a total of $43,500 to his Oracle 401k plan, consisting of $23,500 as an employee contribution, and then $20,000 as an employer profit sharing contribution. So now he wants to make contributions to his solo 401k plan. Let's say he pays himself $80,000 of W-2 wages from his self-employed S corporation IT business. He's not going to be able to make any employee contributions because he will have already maximized that employee contribution to his daytime employer 401k. However, he can contribute an employer profit sharing contribution of 25% of his S corporation W-2 wages. So that would be what, $16,000? Let's make sure that math is correct here. 80,000 times 0.25, that's actually $20,000. So he's going to be able to contribute 25% of $80,000. So that's actually $20,000. So when you multiply 0.25 times 80,000, you get 20,000. So he's going to be able to contribute $20,000 in employer profit sharing contributions to his solo 401k plan. So when you add up the 43,500 plus that $20,000, that means he's going to be able to contribute a total of $63,500 between his daytime employer 401k through Oracle Corporation and also through his solo 401k plan for his IT S corporation business, where he can make a $20,000 employer profit sharing contribution. So there's obviously a typo here. Okay, so that there's an example. So you want to make sure that you avoid some mistakes when you're making contributions to both your daytime employer 401k as well as your solo 401k plan. So you want to make sure that you don't contribute 23,500 of employee contributions to each 401k plan. These are the 2025 contribution figures. So again, make sure that you don't contribute that. And then you want to make sure that you do not double up on those employee contributions because it could trigger what's referred to as excess contributions. An excess contribution, as the word implies, is when you contribute more than you're allowed to contribute to a 401k. And with the solo 401k, when it comes to excess contributions, you've got separate excess contribution regulations that apply to each source. So you've got separate rules that apply to excess employee solo 401k contributions, and then also separate rules that apply to employer profit share and excess contributions. So you always want to track the contributions across all plans. One way to do that is actually pretty easy because the solo 401k plan is going to have separate holding accounts for each source of funds. So with the solo 401k, it's made up of three separate buckets, aka sources. You've got the pre-tax bucket. Let me get back to that slide here. You've got the Roth bucket and you've got the voluntary after-tax bucket, which translates to having separate bank or brokerage accounts for each source. So this means that when you open the solo 401k plan, it's not going to be three separate solo 401k plans. It's considered just one plan with three separate holding accounts, three separate buckets. So you've got the, let's say you want to make an employee pre-tax solo 401k contribution, you would make that to the pre-tax solo 401k bucket. If you want to make a Roth solo 401k contribution, that would be deposited to the Roth solo 401k bucket. If you make a voluntary after-tax solo 401k contribution, that gets deposited to the voluntary after-tax solo 401k bucket. So this slide on the left is an example of a one participant plan. On the right, that's an example of a two participant plan. Let's say both spouses are self-employed in the same business and they both participate in the same solo 401k plan. Because they're both working under the same business, it's considered just one plan. So they're going to have a total of 6 brokerage accounts, aka holding accounts, under that one plan to hold their respective sources. So it's not 6 separate solo 401k plans. It's one plan with 6 different holding accounts, aka bank or brokerage accounts, and therefore it's one employer identification number. Because the plan is a retirement trust, it'll have its own separate employer identification number. You cannot use your business EIN number. Okay, let's see here. Let's take a look at some more content here on today's topic, which is, can I max out my 401k and solo 401k? So we just finished discussing avoiding mistakes. Okay. Thank you for your comment there. We appreciate it. Again, go ahead and type over your questions during today's daily webinar, and we'll go ahead and answer those questions as they come in. So here's the bonus strategy, the Mega Backdoor Roth. So what's great about the Mega Backdoor Roth is that it allows for voluntary after-tax contributions as well as in-plan Roth conversions. Also, the voluntary after-tax solo 401k contributions are not impacted by contributions made to your daytime employer 401k. So even if you max out your daytime employer 401k plan, you're still going to be able to max out your voluntary after-tax solo 401k contributions. So that's one of the great things about the solo 401k plan, is that you can max out your Mega Backdoor Roth strategy even if you've maximized contributions to your daytime employer 401k plan. So let's say that, using the Oracle example, let's say that you participate in the Oracle 401k, and for tax year 2025, you maxed out all the contributions to your Oracle 401k. Let's say the full $70,000 overall limit. Well, that's not going to impact, give me a moment here. That's not going to impact your voluntary after-tax solo 401k contributions. So let's say that you are an IT consultant and you open a solo 401k plan as well. Let's say your IT consultant business is an S corporation. And if you pay yourself, let's say $70,000 of W-2 wages from your S corporation, your IT S corporation consulting business, you're going to be able to contribute that entire $70,000 in voluntary after-tax solo 401k contributions, because it's a dollar for dollar calculation. You're going to be able to contribute that to your voluntary after-tax solo 401k bucket, and then you can turn around and convert that over to the Roth Solo 401k bucket right away. So yes, you heard that right. Even if you maximize your daytime employer 401k contributions, you're still going to utilize the Mega Backdoor Roth strategy through the solo 401k plan up to the overall limit of $70,000. And that's because voluntary after-tax solo 401k contributions are never impacted by contributions that you make to your daytime employer 401k. The only type of contribution that's impacted by contributions you make to your daytime employer 401k are the employee contributions, not the employer contributions and not the voluntary after-tax solo 401k contributions. So the Mega Backdoor Roth Solo 401k strategy is where you have a plan from a company like my Solo 401k Financial, whose plan allows for voluntary after-tax solo 401k contributions as well as conversions. And we handle the reporting of that Mega Backdoor Roth Solo 401k strategy. And that's available to both participants in the plan. This slide here is an example of a one participant plan where that individual utilizes the Mega Backdoor Roth strategy. Here's an example of a two participant plan. Let's say both spouses are self-employed in the same business. Let's say both spouses work for Oracle as their full-time employer 401k. Let's say both spouses maximize their annual contributions to their Oracle 401k. So they each contribute $70,000 to that Oracle 401k plan. Well, they could also maximize their Mega Backdoor Roth Solo 401k strategy to their self-employed business if they're both working under that same business. And therefore, they could each make a $70,000 contribution to the voluntary after-tax solo 401k bucket for a total of $140,000 and then convert those contributions to the Roth Solo 401k buckets. So now both spouses in total have contributed a total of $140,000 in Roth Solo 401k contributions for tax year 2025. Now, some items to understand about the Mega Backdoor Roth Solo 401k strategy is that catch-up contributions for those who are age 50 or older, where they can make a normal catch-up contribution of $7,500, or those who are within the age range of 60, 61, 62, or 63 can make a super catch-up contribution of $11,250. Well, those contributions can never be contributed to the voluntary after-tax solo 401k bucket. Those have to be made to the employee pre-tax solo 401k bucket or the employee Roth Solo 401k bucket. Now, I know I'm throwing a lot at you here, but we're talking about tax year 2025. For tax year 2026, regarding the normal catch-up contribution and the super catch-up contribution, there are some regulations that may impact whether or not you can make those, the normal catch-up contribution or the super catch-up contribution to the Roth Solo 401k. You may have to make those to the pre-tax solo 401k bucket going forward. Or actually the other way around, excuse me. You may no longer be able to make the normal catch-up contribution or the super catch-up contribution to the pre-tax solo 401k bucket starting in tax year 2026. You may have to apply those to the Roth Solo 401k bucket going forward. But the regulation is not clear as to whether or not it applies to sole proprietorships or partnerships. The regulation talks about how it applies to W-2 wages. So more to come on that front, but not to get too much off topic here. All right, let's see if we have any other questions here. Now, let's see here. Now, again, if this information is helping you feel more confident about your future, please take a second to like and subscribe so that we can get this out to other solopreneurs like you. We're almost done here with today's daily webinar, so make sure to type over your questions if you haven't already. We've got a question here from Iwa. Are you also helping with the 5,500 forms once the balance goes over 250? Is the 5,500 prep included in your annual fee? Good question. So yes, we handle reporting for the solo 401k plan as the plan provider. Now, as long as you timely request the preparation of the Form 5500 Easy or the Form 1099-R, we will prepare those for you and file them with the IRS. They'll get filed electronically. And that's included in our annual fee. We don't charge additional fees for that service, provided you timely request that service, because keep in mind, as I mentioned earlier in our conversation, we don't have access to our clients' money. That's why we have so many clients, because clients like to use our services because they can choose where to hold their solo 401k funds at. Many of them choose to hold their funds at their local bank, their brokerage firm of choice. So we don't make them use a particular financial institution, but we don't have access to our clients' funds. So they notify us when they need assistance in preparing Form 1099-R as well as Form 5500 Easy. And again, as long as you timely request that service, we'll gladly prepare it at no additional cost. All right, great question. Now, again, we're coming towards the end of our daily webinar here, so go ahead and type over any questions you might have. So in summary, you can have both a 401k and a solo 401k. The employee limit applies across both solo 401k plans, across both plans. The daytime employer 401k as well as the solo 401k. Employer profit sharing contributions do not, they are separate. So they apply, so you can double up on employer profit sharing contributions. In other words, you can contribute to your daytime employer 401k by the employer making profit sharing contributions, which will be based on your daytime employer W-2 wages. You can make employer profit sharing contributions to your solo 401k, which will be based on your self-employment earned income. Voluntary after-tax solo 401k contributions are not aggregated, they're separate. Therefore, even if you maximize your daytime employer contributions to that daytime employer 401k, you can still maximize the voluntary after-tax solo 401k contribution to your solo 401k as part of the Mega Backdoor Roth strategy. Now, notice I did not mention a 403b plan. I'm talking about a daytime employer 401k, not a 403b plan. Those are completely separate regulations, and we'll have to do a separate webinar on that topic. 403bs are their own animal, and they have aggregation rules that apply across all contribution sources: employee, employer, and voluntary after-tax contributions. Again, it's more summary here. Avoid excess contributions, because excess contributions to a solo 401k plan can get pretty complicated, because their separate rules apply at the employee and employer level when removing excess contributions made to a solo 401k. And lastly, understand how to use the Mega Backdoor Roth solo 401k strategy for maximum growth. All right. Looks like we have a question here that came up. I already have a C Corp set up. Will I still have to pay the same setup fee? I'm not sure what you mean by that. So we don't set up C corporations here for a solo 401k plan. So we specialize in setting up solo 401k plans. And keep in mind, a solo 401k plan is not for funding your business. A solo 401k does not allow to fund your own business with your solo 401k. Maybe you're referring to the rollover business startup 401k, also known as the business financing 401k. That requires a C corporation. And keep in mind that that's a whole different animal. We do offer that service. Take a look at our website. All right. So again, thank you for joining today's daily webinar. We've come to the end of our session. So again, that's it for today's session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Until next time, have a great rest of the day. Oh, looks like we have another question here. Just snuck in. Are you helping with the whole initial plan documents and also adding spouse? Yes, that's what we specialize here at my solo 401k financial. As our name implies, My Solo 401k Financial, we specialize in establishing solo 401k plans. All right. Thank you. Have a great rest of the day.